am Dr.V.Subhamathi, working as an Associate Professor, Department of Management Studies, Bharat Institute of Higher Education and Research, Chennai. Course code P20Mbmc028. Subject name Financial Management. What is finance? Finance, provision of money at the time when it is required. In an organization, definitely we need money. So here finance means just a provision of money at the time of when it is required. Public finance and private finance, there are two classifications. Public finance. 1. Government institutions, state governments, central governments. Private finance. Private finance, business finance, finance of NGOs. Government institutions. So definitely they also need the money to run the government. State government also needs finance and central governments also needs a finance. And private finance means here the banking institutions, private institutions, they also require the money. And business finance and NGOs, even non-government organizations, for the service basis they were starting the business, for them also requires the finance. So without finance there is no any organizations. So provision of money at the time when it is required, that is called as finance. Business finance. Here one definition is there. VLS defines business activity which is concerned with the acquisition and conservation of capital funds in meeting the financial needs and overall objectives of business enterprises. So this is defines that business finance is just business activity which is concerned with the acquisition and conservation of capital funds in meeting the financial needs. So definitely in an organization they are having the different goals and objectives. To meet that goal and to meet that objectives, definitely they need the money. So business activities, definitely how they are going to get that money and how they are going to use that money with a minimum returns. So that is a business activities just to meet the objectives of the business enterprise. For that they need the financials. And business finances can be classified into again different categories. So first one is the sole proprietary finance. Sole proprietary finance means here sole trader. Sole trader. A single person is starting the business, so he is able to get all the profits and losses which is getting in his business. That thing will bear only that person. That is called as sole proprietorship. Second one, partnership. So two or more than the person, they are starting together the business to get the profit. If anything gets the profit, they'll share. If anything gets loss in that business, they should bear. So that is the partnership firms is indicating. And corporate and companies, yes, minimum 7 members will be there in the companies. So in the same way they are starting the company and they are getting the benefit whatever they are getting in the business. And aims of finance function. What is the main aim of this finance activity in the organization? So first one, anticipation of funds needed. So definitely in a finance department, they should assume that what are all the financial requirements may be there in our organization. That is the anticipation of the funds needed. So first one, evaluate the available investment assets or projects. So first thing he has to evaluate what are all the investments assets are there, what are all the projects are there. If we invested into that project or that asset, mean when we will get the return, how much we will get the return. So that is the anticipated of the funds needed and what are the investments, projects and assets are available in the market, that is they should understand first. Second one, to anticipate the funds required for financing the selected assets of the project. So for that asset, for that project, how much money is required? So that is to anticipate the funds required for financing the selected assets of the projects. So this is the anticipated of funds needed. Second one, acquire the anticipated funds. So where he is going to get that money? That is called as acquiring the anticipated needs. Yes, I have decided that I need this much money. So where I am going to get that money? That is anticipated. So to assess that required needs of a firm and then arrange the funds needed by the rising from suitable sources of finances. So in our market, we can able to say n number of sources of finances are there. So as a financial manager, as some other person, he has to think that which is the right source, which is giving the very minimum cost. So that he has to think to assess the required needs of a firm and then arrange the funds needed by the rising from a suitable sources of finances. Second one, it should be at least the possible cost and should not affect the owner's interest. So that amount where we are going to get, that amount should give the minimum cost for the owner. That should not affect the owner's interest. That is which they should take care. And allocation or utilization of funds. First thing, he has to anticipate the financial needs. Second thing, where he is going to acquire that funds. Third thing is how that money he is going to utilize. So investing funds on a profitable projects, that is project of assets that provide the return. So that money he has to invest into the profitable one. That is the important activity. And increasing the profitability. So to increase the profit by reducing the cost or minimizing the waste or effective utilization of available resources. So he has to use that money into a profitable one. That is very important. And next one is the maximizing the firm's value. That money that should create a brand image for the organization. So organization is to maximize the firm's value by taking the right decisions so as to finance function. So this is the maximization of the firm's value. Next important aspect in the finance, approaches to finance functions. Approaches to finance functions. So first approach is traditional approaches. Second one is modern approaches. First one, traditional approaches. Rising of funds from financial institutions, rising of funds through financial instruments, shares and bonds from the capital market, legal and accounting relationship between an enterprise and its sources of funds, creditors. So that is creditors. So first, traditional way. So what is the finance function is doing means in a traditional way, they're supposed to raise the funds from the financial institutions for the organization. That is the first one. Second one, rising of the funds through financial instruments, whether that person has to think that is there any possible way to issue the financial instruments to the public in the form of shares and bonds. If we can able to give in such a manner, that would be giving the maximum value for the organization. That is the second one. And a legal and accounting relationship between an enterprise and the sources of funds. So whether some X persons, one Y persons, they are ready to give the funds with the high interest rates, whether that is available or not. So that is the traditional approach which is playing for the departments of the finance. Some of the criticisms are there for this traditional approach. So first one, ignored day-to-day problems. Financial problems arising in the course of the episodic events. So if we are following the traditional approach for the organizations, means we cannot solve the problem which is happening day-to-day activities in the organizations. So this is completely ignoring the day-to-day problems. And outsiders looking in approach, equated the functions with the issue involved in raising and administrating funds. So this is the equated the functions with the issues involved in raising the and administrating funds. So this is again second criticism for the traditional approach. Ignored working capital financing, again same thing, day-to-day activities. So overemphasis on long-term financing problems. Ignored the allocation of capital, procurement of funds from outside. So only they are able to get the funds from the outside only. So that is again a allocation of capital is missing. So capital issues of financial management, like should an enterprise commit the capital funds to certain purposes? Do the expected returns meet the financial standards of performance? How does the cost vary with the mixture of financing methods used? So these are all the A. Ignore the allocation of the capital for the organization. Modern approach. It covers conceptual and analytical framework for financial decision making. So far we have seen traditional approach. This is a modern approach. The main content of new approach is what is the total volume of funds and an enterprise should commit? What specific assets should an enterprise acquire? How should the required funds be financed? The new trends are increased use of information technology, globalization of business. So this is the modern approach. So far we have seen traditional. So modern approach is completely indicating as is how to use the information technology to raise the funds and globalization of business. So that modern approach we can able to get for the organization. What is financial management? So far we have discussed what is finance. Next one is financial management. So to collect the finance for the company at a lowest cost. To use this collected finance for earning the maximum profit. Only these two things the financial management is going to do for the organization. So first thing is to collect the finance for the company at the lowest cost, and second thing how that amount we are going to use to get the maximum profit. So meaning financial management deals with procurement of funds and effective utilization of funds in the business. Financial management is the art of planning, organizing, directing and controlling financial activities in a business organization, namely procurement and utilization of funds including cash and credit. Definition. According to Dr. S.N. Maheshwari, financial management is concerned with the raising of financial resources and their effective utilization towards achieving the organizational goals. Objectives of financial management. There are these two objectives of financial management will be there for every organization. Without these two objectives, there is no any organization. So first one is profit maximization, second one is wealth maximization. What are all the functions of financial management? Estimation of the financial requirements, selection of the right sources of funds, allocation of funds, analysis and interpretation of financial performances, analysis of cost, volume, profit, capital budgeting, working capital management, profit planning and controlling, fair returns to investors. So these are all the functions of financial management. So first thing is we should estimate the financial requirement. Second one, right sources of funds for the organization. A number of sources are there. What is the best source? That is we have to choose. Allocation of funds. Yes, we got the money. So next where I am going to allocate that funds. And analysis and interpretation of the financial performances. Analysis of cost, volume, profit. And capital budgeting means just a long-term investment. And working capital management means day-to-day requirements. And profit planning and control. So fair returns to the investor. So these are all the main functions of the financial management. Importance of financial management. Financial planning to determine the financial requirement of the business concern and leads to take a financial planning of the concern. Second one, acquisition of finance, the acquisition of required finance to the business concern. Proper use of funds. Proper use and allocation of funds leads to improve the operational efficiency of the business concern. Financial decision. It helps to take sound financial decision in the business concern. Improve profitability. It purely depends on the effectiveness and proper utilization of funds by the business concern. Increase the value of the firm. It is very important in the field of increasing the wealth of the investors and the business concern. So these are all the importance of the financial management. Functions of financial manager. If any student is getting the degree related to finance, that person should think that how he has to convert into as the financial manager. So here some of the functions are there only applicable for the financial manager. First one, forecasting the financial requirements, acquiring the necessary capital, investment decision, cash management, interrelation with other departments. So first and foremost function, forecast the financial requirements. What are the financial requirements may come for our organization? Second one, acquiring necessary capital, where he has to get. Third one, where he has to invest, and cash management in the organization, and financial manager has to maintain a good relationship with all other departments, because if that person is not able to maintain a good relationship with the other departments, means he cannot able to estimate the financial requirements for the organization. So that he has to maintain a good relationship with the other departments too. Organization of finance function. Structure of organization of financial management vary from firm to firm depending on size, nature, operations, capabilities, and finance functions. Different roles and designations. Financial manager, chief financial officer, financial controller. Director of finance, vice president finance. Two important subordinates are there. So first one is treasurer, involved in financial and investment activities. Second one is controller, management and control of assets. So these are all the organization of financial function will take place in all the organizations. So this is the chart. Board of directors, the vice president of operation, vice president of finance, vice president of sales. So this is the normally 3 vice presidents will be there in the all the organizations. So under the vice president of finance, again there are 2 important subordinates will be there. First one treasurer, second one controller. So treasurer, again he has to have some of the roles and responsibilities in the organization. So first one, capital budgeting, commercial and investment banking, portfolio manager, and cash management, credit management, fundraising manager, and inventory manager. These are the responsibilities should take care as a treasurer in the organization. And controller, cost accounting, financial accounting manager, and preparing the budgets. Data processing manager, tax manager, financial statement preparations, and preparing the budget. So based upon the budget, treasurer has to maintain the all the departmental activities for the organization. Next, fundamental principles of finance. So time value of money, risk and return trade-off, cash flows, principle of cost of capital, principle of maturity of payment, principle of equity position, and leverages. So these are all the main fundamental principles of finance. Financial decisions. So every financial decision is very important. If one thing happened wrong, that is giving a complete loss for the organization. So before taking of any financial decision, he has to take it very carefully. Otherwise, it is giving a very big loss to the organization. So that financial decisions again classified into 4 categories. First one is the financing decision, investment decision, dividend decision, liquidity decision. So financial manager, financial functions or financial decisions. So investment decision means here where he has to invest his money to get the returns for the organization. So company's money he is going to invest. So for that investment he should get the some returns. So where he has to invest and when he will get the return and how much the company will get the benefit through that investment. That is called as investment decision. Finance decision. Finance decision, only 2 things where he is going to get that money. Procurement and utilization of the financial funds. That is called as finance decision. Liquidity decision. Liquidity means easily convertible into cash. So he is investing some money into the investment. How many days it required to convert into cash? That is very important. That is called as liquidity decision. And last one is the dividend decision. So public, that means investors are investing their money into our company. So for them we need to give some returns to them. So that is called as dividend decision. So dividend means a portion of profit. So how much we need to give? How much we can able to give the profit to our investors? That decision is called as dividend decision. So these four things definitely will have some risk and some have return. So that is the basic goal for the financial manager. So this is the normal, what are the functional activity will takes place in the finance department. Just a picture, working capital management, dividend payout policy, capital structure and capital budgeting decision. So first, a working capital management means day-to-day requirements for the organization. He has to assume and he has to procure the funds for the day-to-day activities. That is called as working capital management. Dividend payout decision means how much portion of profit we should give to our investors. So that decision is called as dividend payout. Capital structure means the mixture of debt and equity. So how much debt is there in the capital and how much equity is there. So for debenture holders we need to pay the interest, for equity shareholders we need to pay the dividends. That decision is called as capital structure. And capital budgeting decision is nothing but just a long-term investment, so where we need to invest our money. That is called as capital budgeting decision. And investment decision, dividend decision, financing decision, three things is called as the completely financial management. Investment decision. So investment decisions are to be made with regard to the utilization of funds in one activity or the other. It involves the following: determining the total investment employed in the business, determining the size of investment in the permanent assets, that is long-term investment, determining the size of investment in the current assets, that is short-term investment, deciding about allocation of funds to each investment proposals, evaluating of investments in relation to their expected risk and return, deciding optimum capital structure, deciding about the financial performance of each activity, estimating the firm's investment opportunities regarding mergers and amalgamations with other companies. Financing decision. It refers to how the total funds required by the firms will be made available through financial instruments such as shares, debentures, raising of loans and retained earnings. It involves the following: determining the best finance mix or capital structure of the firm, determining the optimum proportion of the equity and debt capital, deciding about optimum level of cash flow requirements, deciding about borrowing policy of the company, negotiating for finance, which is the continuous process, deciding on cost of financing, risk, repayment schedule, etc. Dividend decision. Dividend decision refers to the decision in respect of the part of profit that will be given to the shareholders in the form of cash dividend and the amount that will be kept back of for utilization by the firm. It involves the following: determining the amount of surplus to be distributed as a dividend to shareholders, decisions regarding formulation of the dividend policy, decisions regarding allocation of profits among the shareholders, decisions regarding formulation of retention policy, ascertaining shareholders' desires regarding returns and their tax rates. Liquidity decision. Liquidity decision is concerned with the management of current assets. Basically, this is the working capital management. Working capital concerned with the management of the current assets. It is a short-term survival. Working capital management is a day-to-day problem of the financial manager. Measuring shareholders' value creation. The two measures used to determine whether an investment positively contributes to the shareholders' wealth are economic value added. Economic value added. So it is a measure of performance evaluation that was employed by Stern and Sarot and Co. It is very popular measure today, which is used to measure the surplus value created by an investment. So how to calculate that EVA? EVA equal to net operating profit after tax minus cost of capital into capital invested. According to this approach, an investment can be accepted only if the surplus is positive. For example, an investment generates net operating profit after tax rupees 20 lakhs and the cost of financing investment is rupees only 16 lakh. That economic value added by investment shall be rupees 4 lakhs and it should be accepted. Example, this is a Paul is the CFO of an organization in Boston. In order to assess the organization's value creation or destruction, so Paul would like to calculate the economic value added for 2015. The organization of part is $3 lakh, some 3 lakh 500 cost of capital is 5% and the organization employed is the 10 lakhs in capital in 2015. By plugging the value into a EVA calculation, above we can calculate the value of the Paul's required CSP. So if he is investing means he is able to get the 34 lakh 50,000. So Paul's organized had a total added value amount rupees is the 34 lakh 54,000, 34 lakh 50,000 in the year of 2015. So this is an example of calculating economic value added for a company. So capital invested and weighted average cost of capital, finance charge, now part and finance charge, economic value added. So 2014, 15 and 16. Total market value added. So it means the difference between the current market value of the firm and book value of capital employed by the firm. The market value of the firm is simply sum of market value of its equity and debt. In case the market value of firm exceeds the book value of capital employed is known as a positive MVA, that is market value added. If the value of capital employed exceeds the market value of the firm is known as negative MVA. So this is a small example for MVA. So for example, if bondholders and shareholders have contributed 10 lakhs to firm company XYZ and during its existence since inception and it is currently listed on the stock exchange with stock market value of $20 lakhs, it can be said that the MVA of the company is rupees 10 lakhs. Financial plan. Statement estimating the amount of capital and determining its composition. Financial planning. Financial planning is the process of estimating the capital required and determining its computation. It is the process of framing the financial policies in relation to procurement, investment and administration of funds of an enterprise. Objectives of financial plan. Adequate funds, balancing of cost and risk, flexibility, simplicity, long-term view, liquidity, optimum use and economy. Principles of sound financial plan. Simplicity based on clear-cut objectives, less dependence on outside sources, flexibility, solvency and liquidity, cost, profitability. Consideration in formulating the financial plan. Nature of the industry, standing of the concern, future plan, availability of the sources, general economic condition, general control. So these are all the things should be considered before formulating of the financial plan. So first we need to understand what is the nature of our industry, or how much standing we can able to there, and what is our future plan, what are all the availability of the sources of funds, and general economic conditions we have to think, and general control. Steps in financial planning. Establishing the financial objectives, formulating financial policies, formulating the procedures, providing the flexibility. Once again, I want to thank Bharat Institute of Higher Education and Research to giving me this opportunity. In this session, we have seen the completely an introduction about the financial management. So I'm Dr. V.Subhamathi, working as Associate Professor in the Department of Management Studies, Bharat Institute of Higher Education and Research. Thank you.